Hello, everybody, and welcome to OpenMike on the open road. Hopefully, we will not get interrupted today the way we did on Monday afternoon when Sophie the dog decided to come up and say hello and step on the surge protector that sent power to everything that I'm using here. So let's talk a little bit. First of all, I know that Ranjana Gupta had a question about Uber, poor man's covered call, versus just a buy right, cash covered put. We're going to get to that. I wanted first, though, very quickly to discuss, well, two things really. So we got earnings out of Carnival and we got earnings out of FedEx. Both did trade a little bit higher. Carnival Cruise, as it happens, was up, I think about, when I was looking at this a little bit earlier today, about 3.5% or so. FedEx, on the other hand, delivered quite an upside surprise. So, and this goes to sort of illustrate the point that I've made a couple of times when we've discussed situations where you are selling upside calls going into events or catalysts, such as earnings. When new information hits the street, that can often be the propellant that moves a stock substantially higher or lower, as essentially investors and traders reset their expectations and their valuations for the stock. FedEx was trading at just under 13 times forward earnings estimates before this news came out. That kind of a low multiple can essentially create the situation that we got, which is that if the news is better than expected, the stock can actually move pretty materially. Interestingly, even doing that doesn't make the stock overwhelmingly expensive. I think it was up 14, 15% actually. Let's just take a quick peek and see where it ended up finishing the day. We are looking at, let's see here, up about 40 bucks. So actually, I guess it finished pretty close to the day's highs, not bad. But importantly, even still, it's not outrageously expensive. This is not all that I was expecting out of the stock. So if you happen to own it and you wrote calls against it or didn't, it's a trade that I think you can stick with. It seems like things are beginning to sort of work out there. Okay, so we do have other meaningful earnings upcoming. Included among those is Nike. Nike is one of my so-called Holly index stocks, so-called because it's one of the brands or companies where we tend to spend some money. In this case, it's usually for my teenage sons. Interestingly, Nike has not done particularly well of late. So if we go back to February 28th or so, we talked about a death cross, the potential for a death cross in some of these other names. That's when Nike actually had one. So it was either the 28th or the 29th of February that the 50-day moving average crossed below the 200, and the stock has done very poorly since then. It has underperformed the consumer discretionary space by about 10% since then, and it has underperformed the S&P 500 by more than 16% since then. And a big part of the reason for this is that growth in Nike revenues had essentially stalled. In fact, most recent revenues were actually lower than they were a little while ago. I think I can actually share my screen and show what I'm talking about here. Let's see what we get. Yep. Okay. So what we're looking at here are the revenues by quarter. And we can see that they're actually a little bit lower than they were, even going back to 2022. Now, by itself, that's not completely the end of the world. It's trading much cheaper than it has historically to earnings. So it's about 23.9 times the consensus estimate. So that's just, basically the average of all the street estimates, which is much cheaper than the name has historically traded. So its longer term average multiple is just under 30. It's about 29.5 times forward earnings estimates. But growth has definitely slowed and actually turned negative. Some of that might be attributable to weakness in consumer discretionary generally. As I pointed out, consumer discretionary has actually underperformed the S&P by about 6% since the end of February. But that's not the entirety of the story. one of the other problems that we're seeing here is that they appear to be losing market share to ON Holdings and to Deckers also for their, one of their athletic shoe brands. And that information, so there have been some study. I'm going to just scroll through. I have some notes here, but there was, and the brand, by the way, the Deckers brand that they've been losing to is called Ola, but there was some analysis of sales out of Dick's Sporting Goods. Now, for those of you who are following the space, we've talked about Dick's Sporting Goods in the past. We have talked about Foot Locker. Foot Locker traded higher in their most recent earnings result. Now, folks may remember that I actually had forecast very early this year that Foot Locker would disappoint. They did, grossly. And the basis for that was that I was looking at Nike's results. And Nike was essentially the biggest brand that Foot Locker was selling. And the logic was that if Nike sales were falling off, it was difficult to see how Foot Locker's sales results could be improving. And of course, that proved prescient. I actually had made a bearish bet on it. Some of you who are following the live stream may have followed along with it. In fact, it didn't do as well as we would have hoped because the downside move in Foot Locker was even sharper than I had anticipated. I think the stock fell close to 30% at one point. Dick's, on the other hand, has basically been knocking it out of the park. So there are some studies that are being done. People are getting essentially access to sales data. And some of the sales data that we've been seeing out of Dick's Sporting Goods suggests that the ON brand and Ola brand from Deckers have been taking market share. And I think I have some notes on this. So I'm just going to, forgive me, I'm just going to quickly scroll down to it because it was some interesting statistics if I can find it. Yes. Okay. So Dick's Sporting Goods, ON's market share, relatively speaking, grew 12%, and Oka's grew by 13% as of the end of May, while Nike's market share slid 39% in January to 32% in May. That was apparently according to Yipit data. I actually hadn't heard of Yipit data before I came across this, but you may be interested in looking into that. Okay. Right now, the options market is implying a move of about 7% after they report, 8% by Friday's close. So the question now is, does this represent a buying opportunity? Let's just take a quick peek here, because as I pointed out, Nike is trading at a discount to its historical multiple. Just bear with me while I bring this up like this. The issue that I have here, though, is that it still trades very poorly, as we can see here. So this is, I know that some of you prefer a candle chart. I'm hoping this shows up reasonably well. We've sort of hooked and crooked to get this particular laptop to share with us here. But now you can sort of take a look at it. And oh, by the way, I'm just going to highlight this, and maybe you'll be able to see my cursor right there. So where are we? We're right in, this is when that death cross took place. February, yeah, so it was February 28th. 50-day moving average in purple, or actually, I guess that's closer to pink, and the 200 here in, 200 in yellow. So my thinking is that, we have a couple reasons that we think things could be brightening a little bit. And also we have this valuation situation, which might be a bit compelling. But the fact is they're losing share. It's hard to get super enthusiastic. So my thinking is that if you are inclined to make a bullish bet, and let me see if I can bring up, I think I can, this other screen. I'm going to pull up options play on the other machine here if I can. And let's see if that, is that this screen? This one? Aha! There we go. So we're just going to log on to that. I think an upside call calendar is probably a good way to play this. So let's just structure that really quickly. I'm not really interested in trying to catch the falling knife, as it were. So I don't know that it necessarily makes sense to buy the stock outright here until we get some new information that actually suggests that we are seeing some stabilization in their sales on a relative basis. So that's really the part that interests me the most. Is the company actually getting to a point where they're not really losing market share anymore? Now, one of the other things that has been discussed, things like the Olympics, stuff like that, potentially, I'm just going to come back to you so you can see me for a second. That being a way to sort of reignite excitement. I have a little bit of a problem with this. I don't think, as exciting as those events can be, I think that the real propellant for their shoe sales in particular comes more from professional sports, more from basketball, things like that. This is purely anecdotal, but I can just say from witnessing my younger son who plays basketball and what he's interested in as far as Nike products, it's not really going to be fueled by anything outside of sort of that window. The Air Jordan brand obviously is still one of the things that really matters to them. That is probably not going to be, say, for example, based on the Olympics. Okay, so couple quick things. If you are going to use a calendar, I've mentioned this before, things that I prefer, because there's something called a vol crush. The vol crush occurs when an event takes place and you end up seeing options premiums come down as a result of that event. The next event, so if you look where my cursor is, you're going to see I'm looking out to September right now. September regular way is not long enough dated because the subsequent earnings is estimated to take place on September 27th. So you want to own that side at least. So I'm just going to go out to October. I think that covers it. And then look to sell some near dated premium against it. Could be 1 week options, could be, I'm just going to use regular way options, to illustrate this point, but you could get something that looks a little bit like this. Alternatively, if you go shorter dated, because there's a lot of premium, you're going to get a decent amount of offset there. So you could do something like this, buy a longer dated October par call, par meaning the 100 strike, and then sell one of the weekly options, for example, the July 5th weekly. So those are going to be 1 week from this Friday is the expiration of those options. If you wanted, you could also do it as a diagonal. So, bring this strike down a little bit. And in so doing, so the important thing I want to point out, that if you put on a diagonal and you spend less than the distance between the two strikes, the good news about that is that you can't be both right and wrong, which is that you're making, in this case, a bullish bet, betting that a beaten up stock trading at a discount to its historical valuation might somehow get some of its mojo back. So you want to make a bullish bet. Let's say we had done something like that in FedEx. We used a diagonal in FedEx. The advantage of that is that if the upside move is 8%, but you get a move that is 15, 16%. So basically the FedEx situation is a really perfect example of this. You will find that if you do a straight calendar, you have an upside break even, and then even a point where you can potentially lose money. So we're just going to illustrate that here. So straight calendar, 115 would be the upside break even for a July 5th October par call calendar, that's a pretty substantial move, right? So understand that the likelihood that it breaks through that upper break even is quite low. In this case, you're looking at an upside move of 20% or lower. So this trade has a good probability of profit, 62% or so. And part of the reason it has that probability of profit is because the likelihood of it going above that upside break even is very low, and it makes money at spot. So if the stock simply trades sideways, I don't necessarily expect that's what's going to happen. But if it did, it's profitable there. And in fact, it actually could potentially make even a little bit of money, even if the stock trades a little bit lower. So put all of that together, that's fine. But in those circumstances where you think a stock can really make a move, maybe a diagonal makes more sense. It increases the outlay because you're going to be buying a lower strike, longer dated option. So the amount of capital you're going to be committing at the outset is greater. And, the profits that you're going to get are also going to go down on a relative basis as a result of that. The benefit is that you can structure it such that you have no potential loss, no matter how far up the stock goes for a bullish bet or down it goes for a bearish one. So something to think about for Nike. I think it's kind of an interesting setup. The sales data doesn't look particularly compelling for them, and I think that's a big, a lot of this information is sort of publicly available. This Yipit data that I was just sharing with you, you can put that into a Google search or news or something, and you're going to find something about that. But essentially, I think that's what the stock has been trading off of near term. So if we do see some stabilization, we do see some growth, then that I think is a potential upside for Nike. Another important point, though, that I want to make out of this is that what I was bringing up earlier, which is that I had made a bearish bet on Foot Locker earlier this year, and that stock has definitely traded higher. And let's take a look at that. And it is doing so largely on the expectation that Nike's sales are going to recover. So the derivative trade out of Nike's results this week absolutely is going to be Foot Locker. And one of the things we can see here is that if you go back to their most recently reported earnings, which was the end of May, stock traded higher. Expectation was that you were going to get better sales data out of Nike. The interim data that we've gotten from Dick's alternative data sources on Nike sales hasn't been hugely compelling. The market share data that we're getting from Hoka and ON relative to Nike hasn't been particularly compelling for Nike. So if this news coming out of Nike this week is in any way poor, I think it's probably pretty bad news for Foot Locker, and you're going to see that one trade badly out of it. That would be my expectation. And that would be even more true if the high-level data is poor, but their direct-to-consumer business is good, because Foot Locker is not a beneficiary there. So their digital sales stuff, things like that. Okay, so let's try to take some questions then. I'm going to start here at the top. So the first comment was, good morning, Mike. This is from FinWest, and that's just because of FinWest's location. That's the timing there. Hope the dog doesn't step on your cables again. Yeah, so I didn't even realize that I had gone dark for quite a while, until somebody who was watching and realized that had been interrupted managed to get in touch with me and say, "You're not on." There's a lot of electronic stuff around here. It's all going through surge protectors with switches. And Sophie, the dog, came over here, went over there, and managed to step on it and shut the whole thing off. And I didn't actually even realize that. I suspected it because a lot of things were going dark, but I didn't realize I was completely off the air. Okay. Someone says no sound, but someone else says sound fine here. Sound fine here too. So I'm hoping you guys can hear me. I was pleased with the performance of my short puts on FedEx. Good, I'm glad. And this, Ranjana Gupta was asking about Uber. Important point. A buy right, a covered call, maybe to a lesser extent, a poor man's covered call. So that's buying really long dated calls and selling shorter dated ones against it, or selling cash covered puts. These trades are all, they're not exactly synthetically equivalent, but they all have very similar characteristics. They are moderately bullish, willing to be long the stock at some level close to where you are right now, trying to take advantage of decay of near dated options. So, when you take a look at trades like this, be flexible in your thinking. Perhaps you're going to be more willing to sell cash covered puts depending on your circumstance, or maybe you just don't like doing spreads, so that can be an alternative, something to think about. Okay, thoughts on going short with Nvidia pre QE and long post. Okay, so wants to go short July puts and long AugSep calls. Okay, so let's just quickly, let me do this. I'm going to do this. Let's just take a quick peek here at what's going on in terms of timing. So when he's talking about QE, we're talking about quarterly earnings here. So let's just take a look at the calendar. Bear in mind when you look at this table, that just like many other sources, what you're looking at outside of a confirmed earnings date is the estimated date, and it's usually going to be estimated. You want to know, we never know 100% until the company actually announces. They will do that on their IR website. We are going to be releasing earnings, and they will give the time and date. But these estimates are probably a decent starting point. So late August is when we expect the next quarterly earnings release from Nvidia. So Bob Loam, forgive me if I'm not pronouncing that correctly, but Bob was asking thoughts on going short pre-earnings July puts and long post-earnings AugSep call options. Okay, well, we can do this a couple different ways, things to think about. Let me do this first. So just in terms of implied volatility, that is what you're buying versus what you're selling, let's just take a look at the term structure so that we can see what options you are going to be, and I'm just going to get rid of this. And okay, you know what? That's unfortunately, apologize for the delays while I work through this. This is a new installation of Bloomberg. All of these settings are not my defaults. I would not normally have the vol surface going all the way out to December of 30, whenever that is. 32, really? So this is 10 years. Yeah, we do not need to see 10 years of implied volatility data in Nvidia. By the way, for those of you who don't know this, it is not uncommon for institutions to trade long dated vol. So 5, 10-year SPX straddles, strangles, variance swaps, that kind of stuff. Pretty common. Or at least it was when I was still in that business. But at the retail level, yeah, it doesn't happen. Nobody's trading that stuff at the retail self-directed level. Okay, so if you are selling pre-earnings, so if we look at this date right here, this is the 16th of August, and actually this is an important point here. When you are looking at a term structure graph like this one, so the nearest dated expiration are these, and these are options that expire at the end of this week. So don't read a whole lot into that number. You could look at that and say, oh, looks like a great sale. Implied volatility means a whole lot less when you only have 1 or 2 days left. So I'm just going to discount that for a second. The important point I would make about these term structure graphs is you can see when the options market believes the events are taking place by looking at these local peaks. So we can see by looking at this, you can know right away whether or not the options market anticipates that the next quarterly earnings result is going to take place before August 16th or after. And we can see clearly that the options market's expectation is that it's going to be after. Remember that the estimate that Bloomberg is giving for the next quarterly earnings result is going to be on August 23rd. And this makes complete sense. This is in alignment. And then we can actually take a look over here and we can see that there's probably an event that takes place between November 15th and December 20th. Once again, we're seeing that because the December 20th vol is higher. So these peaks and valleys give us a sense of the options market's expectations about when things will take place. Where you can take advantage of that is when there's considerable uncertainty around an event, and we have seen that from time to time. We saw that earlier this year. I think a lot of it was leap year related, where there was considerable difference of opinion about when events would be taking place. And you actually wouldn't have it really well defined in the term structure. And if you think you have a better view on it, sometimes you can take advantage of that. Okay, so what Bob is talking about then is how do we feel about selling this nearer dated vol that doesn't capture earnings and owning the options that do. Couple quick things about this. So first of all, I keep saying it, and that is that generally speaking, being short volatility into events through it. I mean, so selling options, right before an event takes place, where the options actually capture that event, has not statistically proven out to be a great strategy. So in general, if you can own events with your options and be short non-events, to me, that is preferable. So already I like what Bob is doing here a little bit with that in mind. Now, why don't we take a look at a more specific example? And we're just going to go into Nvidia here. And actually, the first thing I want to do is, this is also a candle chart. So I'm just going to pull this up. And, what you will find, even for names like Nvidia, is that, the volatility around the events can be significantly greater. So we don't really mind being short if you want to be long the stock in particular, short options prior to the event, because there is probably not going to be a whole lot of information embedded in a whole lot of new events that are going to be taking place that are embedded in those options. So let's just say, for the sake of argument, that you wanted to sell the 120 puts. I'm just going to put that. Okay. So you could sell the 120 puts. Stock's at 126. You can get about $6.20-ish. Call it $6. Let's just make it a nice round number. You can get $6 for those, and those are not going to capture it. So that's a pretty handy standstill yield. $6 a share on $126 stock for an option that expires in 51 days. If you wanted to go near dated, and actually, why don't we do that for illustrative purposes? I think that's fine. So $3.50 roundabout for an option that expires in 23 days, 120. Not bad, right? So you're going to be getting almost a 3% standstill yield. The risk is that you own the stock if it falls below 120. Notice the strike that I've selected here. This is sort of that level from which we saw that most recent breakout. Handily, that also represents more than a $6 discount from where the stock is currently trading. in a name like Nvidia, is buying the stock 5% lower than its prevailing stock price at the moment a big discount? I would say no, but technically the setup is good. We can see right here that OptionsPlay uses a number of their own proprietary technical indicators, and those are positive. I can actually toggle back here very quickly to take a look at some of the technical indicators for Nvidia on this one. Let's see. So we're just going to run a quick simulation here, take a look at these better performing strategies. So, these strategies. So what are you looking at here? Let me just quickly outline what you're seeing on this table. Ranked best to worst are a number of different trading strategies. Obviously, at the top of this is buy and hold. No big mystery that buy and hold in Nvidia has worked out very handily over the course of the last year. Stock's up 210%, so that's going to work out very nicely. This essentially, what I'm doing is just taking a look at a variety of technical indicators that many traders like to use and how those have performed over the course of the last year and what they are indicating now. So we can see that obviously buy and hold is very straightforward. That's never going to change. It's always going to be long. Using a simple moving average technique, actually that one would be short here, and let's see how and why it would have been. But that actually, on a trading basis, has been pretty good. And that is simply because it violated this moving average over here. And so it actually would have just gone, it would have liquidated its position there. But I don't know that this has been confirmed. So just a quick point of order on that, because we're still hovering right around that level. And as my friend and CNBC colleague Carter Worth, who is a technical analyst, and I am not, or a chartist, I think he would oftentimes prefer to say, you should think about some of these levels sometimes the way he's described it to me. And so I'm just passing on, his wisdom, not my own. That you might think about some of these things a little bit more like a pillow top mattress, that you sort of hit these things and, there can be a little bit of give in and around it. So I don't know that I would confirm that it's saying sell there. We can see that the next three technical indicators, exponential moving average, triangular weighted moving average, those are all positive. You have a handful here that would be short. Okay, so far so good. There is a little bit of support here, and there's a little bit more support apparently at 116. So selling the 120 put. Now we're going to start looking at how this looks if we add a longer dated call option that would capture that event. In order to do that, you would need to trade the SEP options at least, because I think I said the 23rd, so August regular way is not going to get it done. You would get a payoff that looks a little bit like this. Quick and important point about the payoff here, though, and that is that payoff that you're looking at is as of the expiration of the nearer dated option. So essentially what you're going to be doing if you put on a trade like this, and you could do this, by the way, at something even closer to low cost or no cost. Something else you could consider to help mitigate the cost of that structure would actually to be buying a longer dated call spread, or even potentially selling a nearer dated call, so that you're essentially selling a strangle around this, if you will. So we could actually put something like this in, which is definitely something I think is worthy of consideration. Something that looks a little bit like this. The reason being that you're going to offset more of that decay for the longer dated option. You can set the structure up in such a way that you will not lose money at spot, which is part of the objective here. The risk in this trade, the biggest risk, of course, is that the stock drops and that you own it at that downside put strike. But doing this trade, you will still risk less than you would have done had you not sold that upside call. Because remember, at any future moment in time, the stock can either be lower where it is now or higher. It cannot be in two places at once, if you will. So doing a trade like this may make some sense. Of course, if you sell those upside calls and it really takes off, you may feel like you lost some upside. But what's the catalyst? What is it that's going to propel the stock above 140 or 145 or 150, whatever strike you choose from here? And what you'll also observe is that your net outlay, because you're collecting 345 for the downside put, collecting 2.25 for that upside July call, you're not going to be short options going through the August 23rd expiration. Your net cost is going to be the 1273, 1275. We'll use nice round numbers. I think it's easier. That you paid for the September call options, less $5.70 ish for the stuff that you sold. So that's all fairly meaningful, and I think that's a way you could consider playing that. Okay, let's take a look here. What we had here: how to play option if Fed loosens in September 24th meeting. Well, first of all, I'll make the following observation. I am pretty confident that the market would respond positively to a rate cut. The market's responding pretty positively to almost anything and everything. It is an election year. The markets generally do well. A lot of the results we've been seeing, whether it's economic results or earnings results, I think have surprised a lot of people on the street, a lot of pundits who expected that things would be worse than they have been. I would include myself in that number. I actually thought that we were going to see a bigger hit due to rising levels of consumer debt, lower levels of consumer savings, increased rates. I thought these things were going to really start causing some problems. And as evidence of that, one of the things I was looking at were things like auto delinquencies. I've mentioned this before. Auto delinquencies to me are an important barometer of consumer health. And the reason is that consumers are probably willing to default on a lot of things before they risk their transportation. You need that to get around, you get to work and everything else. Folks don't want to get behind on their car payments if they can avoid it. So rising auto loan delinquencies, which we have seen, I viewed that to be a concern. But so far, it's not really translating too badly into consumer spending, best I can tell. So let's see here. I changed from a Nike trader to an investor. Got a sign from my short puts last earnings, so now nursing the position with covered calls. Okay, so that's it. I think that's a good idea. And do I wish it was trading at a below market multiple? I do, simply because, as I've said many times, the S&P's earnings growth year on year generally exceeds GDP growth, right? So if we could just imagine that every publicly traded business simply kept up with the economy, then on a nominal basis, you're looking for 3 to 4% revenue growth year over year. S&P earnings, so that's not the same thing as revenues, but S&P earnings over the course of the last 20 years has grown at about 7% per year, about double the rate of economic growth. And because of that, if you are going to invest in a business and you're looking at its forward multiple relative to the S&P, that's kind of your bogey, right? You want to see 7% nominal earnings growth expectations for your business at a minimum to think that it's a better investment than the S&P is overall, all else equal. And right now, at about 24 times forward, Nike's cheaper than it has been historically. As I mentioned at the top of this, about 29 and a half times forward earnings is its 5-year historical multiple. So when you see revenues flatten out like that and you see margins sort of stagnating or even declining slightly, you really need to see some reinvigoration to justify a multiple that's at or above the S&P more generally, because that's that's the other place you can put your money. You could own Nike and say, okay, I think 24 times forward is great because I'm getting 14, 15% year on year earnings growth. If that's true, spectacular. That's double what the S&P would be expected to generate over a similar period of time. But lately, as that first graph I showed, that's not what we're necessarily seeing for Nike. But I will also say that we're starting to get back to an area where it does look more interesting. And if you're already in it, reasons why you would sell it early, even if you wanted to be long, was if you wanted to harvest a tax loss, for example. At this point of the year, it's highly unlikely that you're going to be doing something like that. That's usually a back half of the year kind of thing that you're going to be thinking about. So my expectation is that selling upside calls brings your cost basis down, generates a little bit of income. All of that makes good sense. Okay, so what else we got here? Let's see, rebooted for sound. If anybody else has a question, let's see here. This one. Hi, Mike. First time I've made it to one of these live. Steve B says, thanks for these. How do you feel about buying high vol stocks and just selling weekly covered calls above? Example, own Tesla, July 5th, 200 calls. Okay, two very quick observations about that, and my comments are helpful, but maybe they're not helpful, but perhaps more helpful is if I show what it is I'm talking about. Oftentimes, options premia look very juicy. Many times, there's a good reason for that. And that is that the reason that options premium are so high is because the stock's volatility is also very high. So what I'm going to do here is I'm just going to take a look at, actually I'm going to ignore this for one moment. I'm just going to look at short dated realized volatility in, so I'm going to do, this is trading days that we're looking at here. So 20 is going to represent, one calendar month's worth, maybe we'll say 22 trading days per month. So just, taking a look back, and this is realized historical. So Tesla's realized volatility over the course of the last month has been about 36.5 vol. That's expressed as an annual number, but we're just looking at 1 month's vol. So now the question is, does it make sense to sell short-dated premiums against a stock as volatile as this one? Two things to think about. One, are we going to be selling premium through an event? We've talked about that before. That's when things really move. So when is the next event? Tesla is going to be announcing earnings on July 19th. So Steve B was asking, how do we feel about selling July 5th options? Okay, well, first of all, great. You're avoiding that catalyst. Not that it needs a catalyst to really move. Take a look at what the stock did today. Up $9, closing on that $200 number again. So the next question is, well, what are you getting paid? Let's take a look at those July 5th options and see. The July 5th options right now, implied volatility is about 46. So that is actually higher than the 1 month realized volatility for Tesla has been. So again, so far so good. This is looking like a decent trade. What else do I happen to like about this though? Next week is a holiday week. Volatility for stocks during holidays is zero. They're not trading. It's not technically true that it's zero because, of course, international markets aren't closed for U.S. Independence Day. But the fact is that there's just fewer hours of trading to do this. So I actually think this makes some sense. What might that look like? What kind of a trade would this be? By the way, just selling the cash-covered Tesla weekly 200 puts for what it's worth would be effectively the same as this trade. So I'm just going to say, all right, so you own 100 shares of it, want to sell some stock against it. Sell some stock. Sell some calls. So we're going to look at these, the July 5th ones, hopefully get these things off right in here. So that's about $4. So that's 2% in a week. Your maximum gain, of course, is going to be if the stock runs to or through that $200 strike price, and you get, $3.60 ish worth of capital appreciation on the stock, plus the money that you collected for selling the call option. And so that works just fine. If you are listening, you can probably hear Sophie the dog barking, but she is not up here right now. So she's not going to switch anything off on us, hopefully. Joe Kamen, with Tesla, were you looking at implied vol or historical vol? Yes, realized vol is what I was looking at, which is, so realized vol, we use these things a little bit interchangeably. Realized vol or historical is what the stock is actually doing. So I'm going to bring this back and we're going to compare the two. So this was the question that he was asking about. And I'm just going to put 22 days. So this is the trailing 22-day realized volatility. And I'm just going to put 1 month options premiums in here. So this is, if you had been selling 1 month options, that is the volatility that you're selling, the white line. And orange is what the stock actually realized. So when this number, so when white is above orange, you'd prefer to have been a seller. And when white is below, you would have preferred to have been a buyer. And if we put in a stock price, which is what I'm going to do here, so we can just take a look at that, we can see what was going on here. So right here, implied vol was very high, but realized vol turned out to be much higher. And that's because the stock went from 142, all the way up here to close to 200, back essentially where we are right now. And yeah, so that's the long and short of it. If you are thinking about a trade like this one, know what causes higher volatility. Take a look at what the options market is providing for you now in terms of the implied volatility level. So as I pointed out, 1 week options, 46 to 50. That incorporates a holiday. No obvious catalysts necessarily. All of those things matter. Now, there are always things that can make a stock move that are not earnings or shareholder meetings or whatever. We obviously had a lot of news in the EV space today. Volkswagen's investment in Rivian, their $5 billion investment, which we didn't actually talk about at the top, but I think that's just sort of important in general. That moved a lot of things and in the space. And of course, Tesla's got a lot of things of their own going on. But that's really the number you want to look at. Take a look at the realized volatility, look at the calendar, try to see whether there are things that you think are going to either create a relatively quiet period or things that are going to light things up a lot. Earnings is always the most obvious one, but shareholder meetings definitely count. Other types of investor presentations. Less relevant for Tesla, but relevant certainly for other businesses is, are companies in a related space going to be having events that take place over that window where there's read-through to the name that you're involved in? And what would examples of that be? Anybody who's involved with retail sales, generally speaking, retail sales numbers look good or bad. So that would be, Amazon and Walmart. Sometimes you see some relationship between the two, sometimes not. Walmart, Target, we can remember that from earlier this year. Walmart had surprisingly good numbers. Target came out before their own earnings and said, we're lowering prices on 5,000 items, and we've already done it on a number of them. Why were they doing that? You knew as soon as they did that, that clearly the sales numbers that they were about to report were going to be disappointing. But in general, there can be some read-through on these things. So don't just look at the name in question. But as for Steve B's question on Tesla, I like the trade. You could do that with cash-covered puts. You can do it by selling calls against the stock that you own, which is probably more likely the scenario that many of you are in. Many people, own Tesla and are just looking to squeeze a little bit more out of it. And it does have, a decent amount of premium. One other quick point, and this is just something I have mentioned on more than one occasion. I did it with Carnival, which is that if there's a lot of leverage on the balance sheet, that can contribute to the volatility. I'm just bringing this one up because I want to show that in Tesla's case, that's actually not going on. The company actually has a net cash position right now. It's interesting for a lot of people who see that there's a lot of volatility here. Thinking about Tesla, I was reading earlier this week that Ford is losing something like $100,000 on every EV they sell. There's an F-150 Lightning in the driveway right now that we had rented. We own a Tesla, but we're on the East Coast right now, and my wife wanted to try out this Lightning. And it's such a different experience, and I just cannot believe, and I just keep coming back to this. It's astonishing to me that the legacy automakers seem to struggle to create a product profitably that is as user-friendly as a Tesla is for their owners. The experience charging these other things is abysmal. I don't know how else to describe it. Now, part of that is where we are, but we're in Massachusetts. I mean, this is a state where it shouldn't be that difficult to get EV charging, and the speeds are not as posted. I've gone to EVgo, Electrify America, and I'm not trying to point fingers at any one of these organizations, but they say, 150 kilowatt charging. No, you're lucky if you're getting 50. That's if the thing's working at all, and it's a 20-minute drive to get there. A complete joke. You have to use an app. You have to hit a button on the side of the car. Tesla, you go up, open up the charge port, plug the thing in, you walk away. 20 minutes later, you got an 80% charge, and they're all over the place. So and they're making money selling these cars, demonstrated by what you're looking at here. Just go back to December of 2020, and you can see that the company had $1.5 billion in preferred, 13, in that neighborhood, $13.2 billion of total debt, $19 billion of cash. So it still had a net cash position, but the cash position has grown, positive cash flow, and they aren't selling Power Stroke F-250s and EcoBoost F-150s. They make their money selling electric cars, and so yeah, I think that's important. What is realized vol? Okay, so as I was just saying, realized vol is historic vol, how much the stock actually moves around. And vol, by the way, for those of you who don't know, another way to think about it, it's just the standard deviation, the annualized standard deviation of the stock. That's what vol is, and that's how we price options. So yeah. So thank you, Mike. Yasmin is asking, is that TradeView? I'm not using TradeView. So the two applications that I'm sharing with you guys most often. So this one is Options Play, and I like to use Options Play. I've been an advisor to Options Play since I met the company's founder, Mark Engelhardt, a number of years ago at a conference. I was just going I like to do this when I go to conferences. I like to see what's out there, what kind of technology is there. And I was just walking through all the, the booths in this sort of display area, and I came across his application, and I liked it because it was very intuitive. But the truth is that even though I have access to other tools, I use it all the time because it's just very quick and easy to construct a strategy and see where the prices are and tinker with things. It's just really, really easy to use, and I find that super helpful. Um, and it's something I can use on my phone. I can use it wherever I want to. This application, on the other hand, here, if for those of you who are, now that you've seen it, if you have never seen it before, this is what a Bloomberg terminal looks like. So you can get your news on here. You can, there's just no way I can possibly begin to delve into everything that's on the terminal. It is incredibly rich, what is offered here. And there's an API that I use so I can pull it into my own models and my own spreadsheets. I use it for that. Most of this information is available in other sources. It just so happens that because I've used it for so long, we're going on 20 years now, old dog, hard for me to learn new tricks, but it's just they enrich it all the time. That's the good news. The bad news is that it's not cheap. It's not really built for retail. In its most stripped down configuration, so not a lot of live market data, because market data is obviously a big and expensive part of these things. It's about $2,500 a month, plus tax. So it's not cheap. And I'm just using this at this point as an individual, and so maybe it's more than most of you will want to spend. But ask the right questions, and we can look up things on the Bloomberg terminal together, and I'm happy to do that. Okay, and what time do we have? Ooh, it's 5:15 already, which means I have occupied close to an hour of your time, which I really appreciate you guys, those of you who have, sticking around for that amount of time with me as I sit around here and try to fumble through this with 3 laptop computers in a remote location without any production assistance. I'm surprised you guys can put up with that. But as it happens, I do have a hit on CNBC coming up at about 5:45. Actually, it's going to be about Nike anyway, so we're going to just be talking about the implied move, what's going on. By the way, if you're interested, the most active contract in Nike was the 100 calls. So seems we'll just take a quick peek here so you guys can see what's going on. So very quickly, we can see that traded more than 2 times its average daily options volume today. Calls outpaced puts, but that's not that unusual. We can see that call volume has indeed outpaced put volume by about 19,000 contracts a day on average, going back to the last 20 trading days. And the most active contract today, 8,000 contracts trade in these SEP 100 calls. That is a suspiciously round number. There's a lot of open interest. Implied volatility is a little bit higher there. So usually when we see implied volatility higher, that suggests that it's buying. Possible. Maybe somebody's just covering some short options ahead of the earnings print. Or maybe someone is adding to it. Now, this didn't trade as a block. It wasn't a single 8,000 block. But the fact that it landed neatly on 8,000 contracts and that it is more than 12 weeks out, that could be the same institutional investor. Actually, let's take a quick peek before I sign off. Let's just take a quick peek and see whether this open interest has been building fairly steadily. Wow, look at that. Okay. So, looks like big portion of this open interest was added around June 5th. So someone's accumulating a big position in the SEP 100 calls. And today, 8,000 more of these things traded. So that's interesting. Take that information however you will. Like, subscribe. Hopefully we're going to have this into back to our more polished, produced environment soon. For those of you who left questions and comments, really appreciate it. Do that. If you leave a question or comment, I'm definitely going to try to answer it if I can. And we will be back next Monday at 4:15 Eastern. Thank you very much for watching.